Today, we're talking about ETFs, one of the simplest ways to invest in 500 companies at once, even if you're just getting started. Imagine you walk into a store, but this isn't a regular store. This store sells tiny pieces of the biggest companies in America: Apple, Microsoft, Amazon, Google, Tesla, Johnson & Johnson, Visa, all of them right there on the shelf. And instead of buying one piece of one company, you can grab a single package that contains a tiny piece of all 500 of them at once. That package is called an ETF. By the end of this video, you'll know exactly what an ETF is, how it works, why it's one of the most powerful tools regular people have for building wealth, and step by step, how to actually buy one. No experience needed, no finance degree, no large amount of money to start. Let's get into it. So what is an ETF? ETF stands for Exchange Traded Fund. That sounds complicated. It's not. Think of it like this. You and 9 of your friends all want to invest in the stock market, but none of you have enough money individually to buy shares in hundreds of different companies. So you all pool your money together, buy a little piece of many companies, and split the ownership. That's essentially what an ETF is, except instead of 10 friends, there are millions of investors. And instead of deciding yourself which companies to buy, the ETF already has a preset list. The most famous example is the S&P 500 ETF. The S&P 500 is an index, a list of the 500 largest publicly traded companies in the United States. An S&P 500 ETF simply buys a tiny slice of all 500 of those companies and packages them into one single investment you can buy. When you buy one share of an S&P 500 ETF, you own a tiny piece of Apple, Microsoft, Amazon, Nvidia, Google, Berkshire Hathaway, and 495 other companies, all at once, with one click. Now, let's back up for a second and talk about why this matters. Before ETFs existed, regular people had basically 2 options. Option 1, put your money in a savings account or a CD and earn almost nothing. Safe, but slowly losing to inflation. Option 2, try to pick individual stocks. Buy shares of specific companies you believed in. But this is incredibly hard to do well. Even professional fund managers, people whose entire job is to pick the right stocks, fail to beat the market most of the time. Most of them. The people with teams of analysts, Bloomberg terminals, decades of experience, most of them can't consistently beat the market. So what chance does the average person have picking individual stocks? ETFs solved this problem. Instead of trying to pick winners, you just buy all of them. You don't need to guess which company will do well. You own all 500. If the American economy grows, your investment grows with it. And historically, the American economy has always grown. Not every single year. There are crashes, recessions, bad years, but over 10, 20, 30 years, it has always gone up. The S&P 500 has averaged around 10% per year over the long run. That's before inflation. After inflation, still around 7%. Every single year on average. Through wars, recessions, crashes, pandemics, the long-term line always goes up. Let's talk about what's actually inside an ETF. When you buy an S&P 500 ETF, say the one called VOO from Vanguard, or SPY from State Street, or IVV from BlackRock, you're buying into a fund that owns shares of 500 companies. The biggest companies get a bigger slice. Right now, the top 5 holdings are Apple, Microsoft, Nvidia, Amazon, and Alphabet. That's Google's parent company. Together, they make up roughly 25% of the entire index. The rest of the 500 companies fill the remaining 75%. Every quarter, the index is rebalanced. Companies that grow bigger get a larger share. Companies that shrink or go bankrupt get removed and replaced. You don't have to do anything. It happens automatically. This is what makes an ETF different from picking individual stocks. If you had put all your money into Blockbuster in 2005, you'd have lost everything when Netflix came along. But if you owned the S&P 500 ETF, Netflix was in there, growing, compensating for Blockbuster's collapse. The index adapts. The losers get replaced by winners, automatically. Now, here's where it gets really interesting: the cost. Old school mutual funds, which tried to do something similar, charged enormous fees, sometimes 1, 2, even 3% per year. That might sound small, but on $100,000, 2% is $2,000 every single year. Gone. Even in years when the fund lost money. ETFs changed everything. The expense ratio, the annual fee, on something like VOO is 0.03%. That's $3 per year on every $10,000 invested. Almost nothing. This difference in fees compounded over 30 years is absolutely enormous. We're talking about hundreds of thousands of dollars difference in your final balance, just from fees. Warren Buffett, arguably the greatest investor of all time, has said publicly that when he dies, his instructions to the trustee of his estate are to put 90% of his wife's inheritance into a low-cost S&P 500 index fund. Not individual stocks, not actively managed funds, a simple, cheap index fund. If that's good enough for Warren Buffett's family, it's probably worth understanding. Let's talk about the different types of ETFs. Because the S&P 500 ETF is the most famous, but it's far from the only one. There are ETFs for almost everything you can imagine. Total market ETFs. These include not just the 500 largest companies, but thousands of smaller ones too. More diversification, slightly more exposure to smaller companies that could grow fast. International ETFs. These invest in companies outside the United States, Europe, Asia, emerging markets. Useful if you want to diversify beyond America. Bond ETFs. Instead of stocks, these hold bonds. Government bonds, corporate bonds. Lower risk, lower return. Good for balancing a portfolio or for people closer to retirement. Sector ETFs. These focus on one specific industry. Technology, healthcare, energy, real estate. If you believe a specific sector will outperform, you can bet on just that sector without picking individual companies. Dividend ETFs. These focus on companies that pay regular dividends. Instead of growth, you get consistent income. Some people build their retirement around dividend ETFs. Thematic ETFs. Clean energy, artificial intelligence, robotics, cannabis. These are more speculative. Higher potential upside, higher potential downside. For most beginners, and honestly for most people period, a simple S&P 500 ETF or total market ETF is all you really need. Everything else is optional. Now let's talk about risk, because nothing is perfect. ETFs are not guaranteed. If the stock market crashes, your ETF crashes with it. In 2008, the S&P 500 dropped nearly 50%. If you had invested $100,000 at the peak, by the bottom you had $50,000. That is painful. That is real money gone, temporarily. And here's the key word, temporarily. By 2013, 5 years later, the market had fully recovered. By 2017, you had more than you started with. By 2024, that $100,000 from 2008 would be worth over $400,000. But only if you didn't sell during the crash. This is the single biggest mistake people make with ETFs. They buy when things are good, panic when things drop, sell at the bottom, lock in their losses, and miss the recovery. The market will crash again. It always does. The question is whether you'll hold through it or panic sell. The people who built wealth with ETFs did one thing. They kept buying, held through the bad years, and let time do the work. Let's talk about how to actually buy an ETF, step by step. Step 1. Choose a brokerage. A brokerage is simply the platform where you buy and sell investments. For beginners in the United States, the most popular options are Fidelity, Charles Schwab, and Vanguard. All three have zero account minimums, zero trading commissions, and are extremely well regulated and safe. Fidelity and Schwab are great for beginners because their apps are easy to use. Vanguard is the home of the original index fund, and slightly better for long-term buy and hold investors. Pick one, go to their website, create an account. It takes about 10 minutes. You'll need your social security number, a bank account to link, and basic personal information. Step 2, fund your account. Once your account is open, link your bank account and transfer money. This usually takes 1 to 3 business days for the funds to settle and become available for investing. Start with whatever you're comfortable with, $100, $500, $1,000. The amount doesn't matter as much as starting. Step 3, search for the ETF you want. Once your money is in, use the search bar to find the ETF. The most common ones for beginners, VOO. That's the Vanguard S&P 500 ETF. Ticker symbol VOO. SPY. That's the Spider S&P 500 ETF, the oldest and most traded ETF in the world. Ticker symbol SPY. VTI. The Vanguard Total Stock Market ETF. Includes more companies than just the S&P 500. ticker symbol VTI. Search the ticker symbol in your brokerage app. Pull up the page. Step 4. Place your order. You'll see a button that says Buy. Click it. You'll have the option to enter how many shares you want, or on most modern platforms, how many dollars you want to invest. This is called a fractional share. You can invest exactly $100, even if one share costs $450. Select Market Order. This means you'll buy at whatever the current price is. Hit Confirm. Done. You now own a piece of 500 American companies. Step 5. Set it and forget it. This is the hardest part for most people because it feels like you should be doing something. You don't need to. Check your account occasionally. Add more money when you can. Don't panic when the market drops. Don't get greedy when it spikes. Just keep going. The best investors are the ones who buy consistently and leave it alone. Let's talk about one strategy that makes ETF investing even more powerful. It's called dollar cost averaging. Dollar cost averaging means investing a fixed amount of money at regular intervals, every month, every paycheck, no matter what the market is doing. Here's why this is so powerful. When the market is up, your fixed amount buys fewer shares. When the market is down, your fixed amount buys more shares at a discount. Over time, this averages out your purchase price. You never buy everything at the top. You automatically buy more when things are cheap. And psychologically, it removes the pressure of timing the market. You don't have to worry about whether today is a good day to invest. You just invest on the same day every month. Automatic, consistent, no decisions needed. Set up an automatic transfer from your bank account to your brokerage. Set up an automatic investment into your ETF. Walk away. Come back in 10 years. Now let's talk about accounts, because where you hold your ETF matters almost as much as which ETF you choose. There are two main types of accounts for most Americans. Taxable brokerage account. This is a regular account. No special tax treatment. You can take your money out anytime. You pay capital gains taxes when you sell. Roth IRA. This is a retirement account. You contribute after-tax dollars, meaning money you've already paid income tax on. It grows completely tax-free. When you take it out in retirement, you pay zero taxes. Zero. On all the growth. If you're investing for the long term, a Roth IRA is one of the best tools available to regular Americans. The limit is $7,000 per year in 2024. After that, a taxable brokerage account. Most people should max out their Roth IRA first, then invest additional money in a regular brokerage account. Let me address some common questions. Is it safe? ETFs are regulated by the SEC. Your money is held by the brokerage, not the fund company. If the brokerage goes bankrupt, your assets are protected up to $500,000 by SIPC insurance. The actual stocks inside the ETF are yours. They can't be taken away. What if the market crashes right after I invest? It might. Probably will at some point. But if you're investing for 10, 20, 30 years, it doesn't matter. Every crash in history has been followed by a recovery and new highs. Every single one. Should I invest a lump sum or spread it out? Research shows lump sum investing outperforms dollar cost averaging about 2/3 of the time because the market goes up more than it goes down. But psychologically, dollar cost averaging is easier for most people. Both work. Pick the one you'll actually stick to. Do I need to watch the market every day? No. Actually, the less you watch, the better most people do. The investors who check their accounts daily tend to make more emotional decisions and perform worse over time. Let's bring it all together. An ETF is a basket of investments, most commonly stocks, that you can buy and sell like a single share. The S&P 500 ETF gives you ownership in 500 of the largest American companies with one purchase. The fees are almost nothing. The diversification is instant. The historical returns have averaged around 10% per year over the long run. You don't need to pick stocks. You don't need to time the market. You don't need a financial advisor. You don't need a lot of money to start. You need a brokerage account, free to open. You need some money, even $50. You need a ticker symbol, VOO, SPY, or VTI. And you need patience. That's it. The people who built real wealth with ETFs didn't do anything complicated. They started. They kept going. They didn't panic. They let time do the work. Your $10,000 in an S&P 500 ETF today, assuming average historical returns, becomes $25,000 in 10 years, $67,000 in 20 years, $174,000 in 30 years, without adding another dollar. Now, imagine if you kept adding money every month. The math gets very interesting very fast. If this video helped you understand ETFs, hit the like button. It genuinely helps more people find this channel. And subscribe, because next week we're talking about the Roth IRA, why it might be the single best account available to regular Americans, how it works, and exactly how to open one, step by step. As always, I'm Rich, and I'll see you in the next